Hey guys, this is AI Mike Zlotnik, not the real Big Mike. Thanks for watching. I love sharing what I've learned about real estate investing over the years, and I'd like to keep you in the loop. Subscribe to the channel for more of my take, and if you want to see the deals we're working on, head over to tempofunding.com.
Hey folks, this is Big Mike Zlotnik, and today's discussion is going to be all about investing in retirement or near retirement. Folks reach retirement or are near retirement. Typically, what is the primary goal? And the primary goal usually is to convert net worth to cash flow. It doesn't mean all investments are cash flow focused. It just means that the cash flow typically needs to increase because the income from the business or a job has diminished or is diminishing. So let's talk about some of the basic strategies, very powerful concepts that one should consider. First of all, it's very important to build an all-weather portfolio. Ray Dalio, one of the greatest investment minds, talks about building 10 to 12 non-correlated investments as part of your portfolio. And these investments typically do well whether the market goes up or down, whether times are good or bad. So that concept, well-diversified all-weather portfolio, always applies. Next, it's important to consider how to compose a portfolio. There are public investments that generally liquid, publicly traded securities, either stocks or bonds or other instruments, as well as private investments. Private investments could be private funds, could be private real estate funds, real estate syndications, could be commodities, etc. So the concept is that a portfolio needs to have both. It needs to have a liquid part and an illiquid part that is more income oriented. Quite often, publicly traded securities, because these markets are very efficient, they lack the cash flow typically, or the cash flow is very limited. Dividend yield on many of the stocks is just too low to build a comfortable portfolio. Many private investments, such as real estate, could build strong, predictable income with downside protection. However, these investments are generally not liquid. So it's important to build a good mix of the portfolio. But the focus shifts, obviously, from wealth creation and wealth growth to wealth preservation and predictable income, higher level of safety, lower level of risk. By the way, lower level of risk and higher safety doesn't mean you have to sacrifice the return. It just means you have to choose better. You have to choose the right type of investments that have downside protection, that have predictable income, but they don't necessarily need to be government bonds or other low yield bonds. There are plenty of investments that could actually create these well protected, well risk mitigated type of investments with still meaningful upside. So just more defensive strategies that we're talking about. As we talked about all-weather portfolio, part of that could be real estate. Of course, every person has different circumstances and they should consult with their professional, their financial planner, their tax planner, their attorney, their CPA. But in general, knowing approximately where you want to go will help before you have the conversation. And also, it's important to consider pure income portfolio versus income and growth. Why some growth is important? Well, because many folks live many years post their retirement, and having their portfolio not only produce income, but continue to appreciate, even creating legacy for the next generation, leaving some money for your kids, or for charitable causes, whatever is important to you, growth could be a part of it. And an income and growth portfolio could be composed of both debt and equity investments. It has to be the right type of approach. Real estate is one of those asset classes that can actually produce both strong current income with a conservative leverage of a mortgage, as well as growth through various rent escalation clauses, long-term leases, and other growth elements that continue to grow the value of the portfolio and at the same time produce predictable, well downside protected income. How much of your portfolio could be in real estate? It's one of the questions that folks have asked. And there's no right or wrong number. It depends. But for sake of discovery, I actually asked a couple of AI tools just to give me an idea. What should a real estate portfolio in terms of the entire portfolio allocation? And interestingly enough, one of the tools that I used gave me 25 to 40% allocation to real estate. That number doesn't seem to be too low or too high. It actually seems to be quite reasonable. And what it indicates also, a significant portion could be still kept in publicly traded, more liquid securities. Obviously, could be bonds, could be stocks, could be funds. So a good mix of the portfolio with ability to achieve liquidity when you need to, at the same time achieve higher predictable steady income in retirement is what most folks seek. Obviously, consult with your attorney, CPA professional. Every circumstance is different. Individuals' goals, objectives, life events, all those things can impact the portfolio. But having a shift of the portfolio from wealth accumulation to wealth preservation and income is generally the goals of the retirement portfolio. And having ability to rebalance periodically is also very important. So keep that in mind. I hope this helps. I hope you continue to learn. And the fact that you are retired doesn't mean you stop learning. In fact, it's the best time to learn. You have more time on your hands. So continue to invest, continue to learn, continue to ask questions, stay curious. Until the next time, thank you.